Are you ready to uncover the secret sauce that can make your investments skyrocket just like Warren Buffett's? Stick around because we're diving into the genius of Buffett's strategies. When Warren Buffett was just 25, he started his first investing firm, Buffett Partnership. And guess what? It wasn't some fancy, complicated Wall Street scheme. No, it was simple, straightforward, and effective. From 1957 to 1969, Buffett Partnership boasted an average return of 29.5%. How did he do it? By using ridiculously simple methods that anyone can follow. As Buffett says, you don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. It's all about rationality and sticking to simple strategies, even when things get tough. I'm Daniel, and welcome back to Mr. Investor, where we make finance fun, simple, and a little bit hilarious. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss out on the next big investment secret. Today, I'm going to teach you 7 investing rules that Buffett used to achieve such high returns. Now, I'm not promising you'll become the next Warren Buffett overnight. After all, he's dedicated his life to this, but following these rules can definitely boost your long-term returns. Ready? Let's jump in. 1. If the business does well, the stock eventually follows. Buffett picked up this gem from one of the greatest investing books of all time, The Intelligent Investor by Benjamin Graham, who also happened to be Buffett's mentor. The rule is simple. If you own a stock, you own a piece of a business. And over the long term, if that business does well, the stock will too. So look for companies that are going to dominate the future. You don't need to be a Wall Street whiz. Just remember, a stock is a piece of a business, and if the business thrives, so will you. Take Coca-Cola, for instance. They've been around forever, and they're still one of the top beverage companies in the world. Why? Because they have a solid business model, a strong brand, and a product that people love. When you invest in a company like Coca-Cola, you're not just buying shares. You're buying a piece of a business that has proven its worth over time. And if Coca-Cola continues to do well, so will its stock. It's that simple. 2. Most news is noise, not news. Buffett has an unpopular opinion. Most news you consume is actually unnecessary when it comes to investing. CNBC, news websites, and even financial YouTubers, like yours truly, are paid to get as many views as possible. They create hype and tension to draw you in. But the truth is, you only need to pay attention to about 5% of that news. As Buffett says, owners of stocks often let the irrational behavior of others influence them. So ignore the noise and focus on what truly matters. Let's be honest. How many times have you seen a sensational headline that made you panic about your investments? Market crash imminent. Sell now before it's too late. It's all designed to get your attention and make you react emotionally. But investing should be rational, not emotional. Focus on the fundamentals of the businesses you invest in, not the daily headlines. Remember, most news is just noise. 3. When you buy a stock, plan to hold it forever. Compound interest is a powerful force. When you get dividends or capital gains and let them compound, your wealth grows like a snowball rolling down a hill. But if you're constantly buying and selling stocks, you're not letting compound interest do its thing. Buffett has owned stocks like Coca-Cola, Wells Fargo, and American Express for over 25 years. The key is to buy high-quality businesses and hold on to them. As the great investor Philip Fisher says, if the job has been correctly done, when a common stock is purchased, the time to sell is almost never. Think about it this way. If you plant a tree, you don't dig it up every few months to see how the roots are doing. You let it grow. The same goes for stocks. Once you've done your research and bought a quality stock, let it grow. Over time, the power of compound interest will work its magic, and you'll see significant returns. 4. Understand what you're investing in. Risk comes from not knowing what you're doing. This rule is as simple as it sounds, yet so many people ignore it. Understand the company you're investing in. Take a look at Buffett's portfolio. Coca-Cola, Southwest Airlines, Apple. These are all businesses that are easy to understand. If you're into cars, look into Ford, Toyota, or Tesla. If you're into e-commerce, check out Amazon or Alibaba. Only buy stocks of companies you understand. It's that simple. Imagine you're buying a car. You wouldn't just buy the first one you see without understanding its features, history, and value, right? The same principle applies to stocks. Before you invest, do your homework. Understand the company's business model, its competitive landscape, and its long-term prospects. This will help you make informed decisions and reduce your investment risk. 5. Be fearful when others are greedy and greedy when others are fearful. This rule is especially relevant in today's market. We've had a bull market for about 11 years now, and everyone thinks they're a stock market genius. But when everyone is greedy, stock prices inflate and it becomes harder to find deals. Buffett has $128 billion in cash right now, ready to pounce when the market dips. Be fearful when others are greedy and greedy when others are fearful. It's human nature to follow the crowd. When everyone is buying, you feel the urge to buy too. But this is exactly when you should be cautious. High stock prices mean lower potential returns. On the other hand, when everyone is selling and the market is in panic mode, that's when you should be looking for opportunities. Stocks are essentially on sale during these times, and this is when you can find great deals. 6. Buy at a price below intrinsic value. This is crucial. No matter how good a company is, it's not worth an infinite price. You must make sure the price you're paying is below or at intrinsic value. Think of it this way. If you're buying a Lamborghini, no one doubts its quality, but is it worth the $350,000 price tag? The same goes for stocks. Understand the intrinsic value before you buy. Check out free investing courses online to learn how to value stocks. This knowledge is priceless. Let's break this down. Intrinsic value is essentially the true worth of a company based on its fundamentals, such as earnings, dividends, and growth potential. If you buy a stock at a price below its intrinsic value, you're essentially buying it at a discount. This gives you a margin of safety and increases your chances of making a profit. So always do your due diligence and make sure you're not overpaying for a stock. 7. Listen to those you know and trust. Even Buffett had mentors like Benjamin Graham and partners like Charlie Munger. The key is to learn from those you trust. Do you really need to listen to every pundit on CNBC or the latest hyped-up YouTuber? No. Listen to the greats like Buffett and Dalio and learn from their insights. It's like having a backstage pass to the minds of the world's best investors. In the age of information overload, it's important to filter out the noise and focus on reliable sources. Follow the advice of seasoned investors who have a proven track record. Learn from their successes and mistakes. This will help you make better investment decisions and avoid common pitfalls. So to wrap it up, let's recap the 7 rules. 1. If the business does well, the stock eventually follows. 2. Most news is noise, not news. 3. When you buy a stock, plan to hold it forever. 4. Understand what you're investing in. 5. Be fearful when others are greedy and greedy when others are fearful. 6. Buy at a price below intrinsic value. 7. Listen to those you know and trust. Follow these rules and you'll be on your way to beating most investors. Thanks for watching, and don't forget to like, subscribe, and hit that notification bell for more tips and tricks on investing. Until next time, this is Daniel from Mr. Investor signing off.